Welcome to the Property Buyer Podcast, where we explore the world of residential and commercial real estate to help you make better decisions about buying, selling, or investing in all types of property. Join me, Rich Harvey, CEO of propertybuyer.com.au and multi-award-winning buyer's advocate. Our podcast features expert interviews, market trends and insights, and practical tips for navigating the complex world of Australian real estate. Whether you're a home buyer, a seasoned property investor, commercial buyer, developer, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge, strategies, and experience and help you achieve your property goals. Well, welcome to another edition of the Property Buyer Podcast. 2023 has been a very challenging year for anyone holding a mortgage in the face of many rapid interest rate rises, and the cash rate is now sitting at 4.35%. Now, many experts and economists have very different opinions on how this will play out in 2024. It's certainly a challenging time for consumers, with cost of living increases hitting their household budgets, and some economists are saying we may tip into recession, while others say the economy is very resilient and it will be business as usual. And how will all these economic changes impact the property market in 2024? To help make sense of these mixed messages out there, I have Paul Bloxham, Chief Economist at HSBC, to share his insights. Welcome, Paul.
Great to be here.
So, Paul, we have a tradition in our podcast to start with a thought of the week, and the thought is the best time to plant a tree was 20 years ago. The second best time is now. A Chinese proverb. What do you take from that quote?
Well, when you're investing, this is what you need to think about, isn't it? What's coming next? And you can easily look back and say to yourself, look, geez, it would, we should have, if we'd known, we would have done this or we would have done that. And of course, that's what this is saying. It's saying you need to think about what's coming in terms of what you do right now. But we all know there are lots of uncertainties as well. So there's some caution that has to be, taken in the way we think about what we're investing into.
Exactly. I mean, I take from that, I often use that line a lot with my clients about buying property. I mean, the cheapest time to buy property is now, and the second cheapest was 20 years ago.
Well, that's because house prices have trended higher. I mean, the question we all will ask, and us economists all sort of grapple with, is, house prices are going to rise in nominal terms, but why should house prices rise any faster than, say, nominal income in the economy? Should we be in a world where house prices perpetually rise? And it's certainly the case that if you look over the past, over a run of decades, it has. House prices have risen. Property prices in general have risen faster than the nominal incomes.
Exactly.
But is that going to be something that we see in a perpetual sense? And a big question there, of course, is, well, over that same period of time, if you look back over the last 30 years, real interest rates have been on a downward trend. They've been falling. Inflation has come down and been more stable. But we might now be at a point where real interest rates aren't going to necessarily be able to fall any further.
So hold those thoughts, because that's what we'll delve into in this podcast. It's fantastic. I love the way you get straight into it. But just before we get into that sort of topic, tell me a little bit about your role at HSBC. What do you do here, and how does your reading on the economy impact the workings at HSBC?
So I'm the Chief Economist for Australia. I cover New Zealand and I cover global commodities for our economics team as well. I've been doing this now for 13 years in this capacity at HSBC. And what that means is I'm in charge of carrying the house view on what's happening in those various areas. So the Australian economy, the New Zealand one, and putting together a view on thematics for the global commodity space. A lot of my role, the primary part of my role is external. It's sort of client facing, and it's about sort of setting together a sensible set of forecasts and a view that you have to obviously keep constantly updated, tying it into the global picture as well, because nothing you say about any of those areas is going to just be influenced by the local economy, and then conveying that view to our clients, conveying it in public, doing these sorts of things as well, talking to the media. And then in terms of what the bank also, the bank is a client in a way, if you think about it that way. There are parts of the bank that obviously want a briefing and update. They want to understand what's going to happen in those various economies over time, and Australia, New Zealand, in the commodity space. So that informs, I guess, the way they think about the outlook as well.
Fantastic. And what got you into economics in the first place?
I did economics at high school and thought it was really great. That's the simple answer. I got a little waylaid. I actually, when I was in my teens, wasn't necessarily on the pathway to being an economist. I wasn't sure what I really wanted to do. I did spent a lot of time around theatres and things like that, doing a lot of stage performance, and that was actually what I was really impassioned about all through my teens, into my 20s as well. But of course, that's a tough gig doing that stuff. So I did that as a hobby. I decided early on that's a hobby, and I'm going to go and study economics. And economics is wonderful. I mean, it just is brilliant. I now spend a lot of my time, or some of my time at least, going to universities and high schools and talking to teachers and trying to convey just how useful it is to be an economist. We are not getting enough people training up in economics.
Exactly.
And economics is brilliant. I mean, in the sense that it gives you a framework for thinking about how the world works. And that's really what it does. It gives you a consistent framework you can apply for thinking about all the various forces at work that help you to understand how we've been, where we are, and how we're going to be travelling going forward.
The cynic often says that the economist always just assumes everything, but I studied economics at Macquarie University and went on to do a master's degree as well, and I loved it because, as you say, it creates a way of thinking. It creates a paradigm. It's not perfect, but if you apply the right set of parameters to an assumption, you can actually work out, it's likely to go down this path. And you've got to keep adjusting that reality model.
You've got to start with something, right? I mean, you've got to have something to frame your view. So the starting point is a simple model, an economic model, and then you build out from that model. And of course, it's not going to be perfect. It can't be. If it was the real economy, it wouldn't be tractable. It's like the old adage that a map is only so good. If you made the map bigger and you made it the size of the world, it wouldn't be any use, right? You can't stick it in your pocket. Exactly. You can't use it to summarize things. So I think economics allows you that toolkit for being able to unpack the events that are happening around you and then try to make some sense as to what they might mean, not just for why and a lot of time we spend as macroeconomists trying to explain where we are right now, because actually the data sets we get are delayed, they're all lagged, they're all got measurement error in them as well. But then of course the real trick, to go to your adage from earlier, is to be able to use that to then project what's going to happen next, or what's coming.
So talking about what's happening right now, what kind of words would you describe where the Australian economy is right now? And we're recording this in late December 23. Where is the economy right now?
Sluggish. Yeah, I mean, we just actually this morning got some GDP numbers for the third quarter, and they showed us that growth is quite tepid. It's quite sluggish.
What's the number? I haven't seen it.
It was 0.2 in the quarter, and it was 2.1 over the year. So 2.1 over the year actually doesn't sound that bad. It sounds like it's decent, except that then you unpack it a little bit, which is what we do, and you discover that population growth was exceeding that. And so actually per capita GDP has been going backwards. It's been falling. It fell by 0.3, right? So sluggish is a sort of way of characterising, look, the overall economy is actually still growing. There's still momentum there. But the primary driver of why it's got momentum is because population growth has been surging. And that's going to be a lot of what we talk about over the next little while, I imagine, because that's a big theme. Population growth has been surging, but the rest of the tightening of monetary policy, lift in interest rates, has been slowing the consumer down so much that actually we've been going backwards on a per capita basis. Our living standards are falling at the moment. Household disposable income at the moment, in real terms, is falling at almost 5% per annum, which is a real hit to the household sector. So sluggish is the best way to characterise it.
Okay. So do you think that Australia is going to slip into recession next year? Is there a risk of that? If you had to if you're a betting man and said, I think it's going to be 40% or 30%, and what would be the major factors that would actually tip us into a technical recession?
So what I'm going to do is turn your question on its head. What do you mean by recession? Because, and look, for your listeners, it's worth unpacking this a little bit more. There is no strict definition of what we mean by recession. Economists don't really agree.
2 quarters of negative growth.
Well, two quarters of negative GDP is what some people refer to as a technical recession. But there have been many occasions. In fact, last year there was one where the US had 2 consecutive quarters of negative GDP, but very strong employment growth, an unemployment rate at very, very low levels. Nothing else in the data set that would tell you that they were in a recession. And so you wouldn't possibly define that as a recession. New Zealand, something similar. Around the turn of the year, they had an exceptionally low unemployment rate. They had 2 consecutive quarters of negative GDP, but you wouldn't call that a recession either. And Europe has been tipping in and out of periods where, it's sluggish growth, but is it in a technical recession or not? So there are multiple ways of thinking about this. So in terms of the strict definition of GDP, will GDP contract for 2 consecutive quarters? I think it's unlikely. it's unlikely because population growth is so strong that tends to support economic activity, and it's difficult to get GDP to fall. But are we actually in a recession right now? Well, GDP per capita is falling. Living standards, disposable incomes are falling quite sharply at the moment. And so you could you could debate that. And then the final one for me, and I think this is the way I always frame whether you are actually in a recession or not, is I would say a recession is when the unemployment rate rises by more than 1.5 percentage points in a short period of time. Because that, if you want a really clear thing that tells you about whether you're in a cyclical downturn that's sharp, it's typically that the unemployment rate is rising quickly and that it's risen by a substantial amount. And at the moment, that's not the case. So the unemployment rate's risen from 3.4% a year ago to now 3.7%. I do think the unemployment rate's going to keep rising all through next year, but I doubt it's going to rise quickly enough to actually be classified as what I would call a recession. So there you go. There's an economist.
Perfect.
There are lots of ways to think about it.
No, that's good. Yeah. That's excellent. So I want to talk about immigration, which we just touched on as well. Australia's obviously ramped up its immigration intake substantially. We're looking at almost 500,000 people who've come into our shores this calendar year. What's your view on the volume of migrants coming, and do you think this will continue to see an impact in creating a property shortage in Australia?
So the first thing to say about the inward migration story is that it was almost entirely expected that we were going to get a pickup in immigration because we reopened the border and we'd had 2 years where we didn't have anyone coming here. And that, in principle, that was always going to be a good story. Because actually at the tail end of 2022, the primary challenge we faced as an economy, and businesses told us this repeatedly, was a skill shortage. We didn't have enough workers. We needed more workers. How are you going to get more workers? Well, the only way to do it rapidly enough is to reopen the border and get immigration. So that has been part of the story. So that's been a good bit. The thing that's surprising is how many people have come and how quickly. The government was forecasting at the tail end of last year that we would have 235,000 people come to Australia in the financial year. We've had over 500,000. So we've had a really significant upside surprise to that number. And for 2023 at least, that's really what's thrown out a lot of the forecasts. For the housing market, there weren't any analysts that I'm aware of who everyone was thinking house prices were going to fall further because interest rates had gone up a lot. And it makes a whole lot of sense that they did that too, because your standard model, which works pretty well, would tell you that interest rates is the key driver of house prices. And when interest rates go up, as they did they've gone up by 425 basis points now, house prices would normally fall by 15 or 20% or maybe even a little bit more. But there's another set of variables that go in those models, and they are around housing supply and housing demand.
Yeah.
And so everyone did the same thing. They put in the government's estimates for how many people were going to arrive, 235,000. Why would we not believe them? Because they're the ones who issue the visas. Surely they're the ones who know how many people are coming. But it turns out we got a massive upside surprise. And that is the fundamental reason, the key reason why house prices, they fell 8% between the middle of 2022 to the beginning of 23, and now they've risen by another 10%. They've bounced right back, and they're at new all-time highs. And that's because we've had this surge in inward migration. More people, tight housing supply, very, very low rental vacancies, pick up in rents, and it encourages more people to become first-home buyers because rents have gone up a lot. There isn't rental availability, so you get involved in the housing market. That is the primary force that's been lifting house prices. And then I guess for your listeners, it's all great to talk about retrospect and where we've been. The question is, where are we going? Well, in my view, house prices are going to slow down a bit. The growth is going to slow down a bit running into 2024, I guess for two key reasons. One, because we're not going to get a repeat of that exceptionally rapid population growth. It will likely slow down. And two, because there is still some lagged effect of the impact of the monetary tightening we've already seen. So the RBA has lifted its policy rate by 425 basis points. The full effect of that on the economy has yet to flow through. A part of that reflects normal lags. There are normal lags in monetary policy, but also it reflects that we've still got about a third of all mortgage holders, as of at the moment, who have to roll off or will roll off those sort of 2 and 3 year fixed rate mortgages that are sub 2% onto higher interest.
Exactly. We really appreciate you tuning in to the Property Buyer podcast, and I hope that you're finding our expert interviews helpful. So that we can keep providing this information and growing our audience, we rely on word of mouth recommendations. If you found this information useful, could I please ask you to share this podcast with your friends, family and colleagues, and ask them to subscribe to the Property Buyer podcast. It would be a big help, and we'd be very grateful for your support. Thanks once again for sharing the links. And now let's get back to the podcast. So that's my question. I mean, we've had 13 interest rate rises, as you say, 425 basis points. It's been one of the most rapid increases we've had in decades. How is that impacting the individual consumer at the household level?
Well, it's definitely impacting the individual consumer, and that's what's evident in the numbers we just got actually fresh today.
Because the buffers, we're seeing the buffers that people have had as coming down. But I guess another question is also, when will the people's buffers be expired?
So there's a few things to unpack there. The first one is household disposable income is falling. It's falling very quickly at the moment. It's fallen 5% over the past year in real terms, so in inflation-adjusted terms. So why is that? Well, one of the reasons is interest rates have gone up. And so that's one of the forces. Actually, the main driver of the fall in disposable income is the high inflation itself, is that inflation is high.
Exactly.
And then another factor that people don't think about much, but actually taxes are rising quite quickly because, well, people are moving into higher tax brackets because inflation's running quickly. So that combination of things is weakening household disposable incomes, but you can definitely point to a big part of it being the interest rate effect in terms of slowing down that disposable income. The other thing is that's exactly what the RBA had intended in principle, because they lifted interest rates to slow the economy to get inflation down. So they were intending that this would slow down consumer demand. That's the mechanism. That's the primary mechanism for getting inflation to come back down. Now, in terms of how many people are actually really, where are we at in terms of how much effect it's having on different parts of the population? The RBA has given us some estimates of this. They've told us in their financial stability review that if you take the number of people who are who have owner-occupied variable mortgages, and you look at the proportion of them that are spending their entire income to meet their basics, their basic living, for basic living, if you go back 18 months prior to interest rates rising, that would have been sort of 1% of that group, and now it's about 5% of that group. So that's what they would say. Now, there's a caveat. They say that actually if you include in that standard basic set of expenditures health insurance and private health insurance and private schools, then that number goes up to being 13% of that proportion of the population, okay? So that's how many people are really up against it, who are really quite squeezed by what's been going on, okay? So then the question is, well, what are those people doing? Because they've got income, their income is being all used up in to meet their expenditure. Well, they've got buffers. And they built up those buffers through the pandemic, even more so than normal, because we saved a lot of the transfers that came to us from the government. And they've been working through those buffers. And so the RBA also give us estimates of how much buffer we've got. And the estimate from the last financial stability review is something along the lines of about a 6-month buffer for a lot of those households. So at that point, it's going to start to become a lot more pressing. Now, there are a couple of other factors to keep in mind. One of them is, while the labour market still remains quite strong and the unemployment rate remains quite low, and we've got people in jobs, that's usually one of the key triggers for keeping people attached to their mortgages and keeping them able to meet their spending needs and so on. And so if the labour market softens a bit further, that will weaken that picture as well. And then a final one, which I think is important and we need to keep in mind as well, is often a harder economic landing comes about, or a recession if you want to try and define it that way, comes about when you get the combination of people losing their jobs, but also their house prices falling such that their house is then in negative equity, so that you really are in a real bind. But at the moment, because house prices have been rising, there is almost no mortgages in Australia on the RBA.
And we call that the wealth effect, right?
Yeah, well,
people feel wealthier in some ways because their house prices, they kind of think of it as a big credit card in some ways, even though they may not access it. But that's just a feeling that I think people have.
That's true, although I'm not really trying to get at a wealth effect. What I'm trying to get at is an actual binding constraint.
Gotcha.
The binding constraint for a household, if they really, really struggle, is, well, one possibility is you really struggle, you can actually sell your property. Yeah. Can you sell your property? Well, you can't if the prices are falling and you're in negative equity, and that makes, but in an environment where house prices are rising and you're in an environment where actually there are no houses, mortgages in negative equity, well, the house can be sold. That smooths the way. It provides one pathway at least to mean that the economy doesn't have this sort of harder landing, this larger cascading effect.
Got it.
So, having said all of that, there's no easy way to put it, and that is the economy needs to slow down in order to get inflation down. Yeah. The problem is, if you don't get the inflation down, you're actually having an even more challenging impact on a whole range of households, because the inflation itself, the high inflation itself, is the problem. That's the biggest force that's actually weighing on disposable incomes, is the high inflation itself. The way we get the inflation down is we slow the economy down using interest rates, and then that affects another group of the population as well. There are lots of trade-offs in all of this, but so far we seem to be going through this without ending up in a hard landing.
Excellent. That's a great analysis there, Paul. I want to ask you about the timing or the transmission. We touched on the transmission of timing of interest rate impacts, and we've seen that the transmission rate's been slowed. I mean, I heard it used to be about a 6-month sort of timing from when an interest rate was announced to having its full impact in the economy. But because people have been on these fixed mortgages, it seems people have been sheltered from the real impact. Now, people coming off their mortgages are now really feeling the impact. But what would you say will be the timing of the penultimate sort of smack in the face? This is the the real hit, if you like, from all these rate rises. Is it going to come middle of 24? Like, I'm not asking you to say it's going to happen on the 23rd of March next year, but like, you said I'm getting at in terms of a timing.
I do, but I guess I don't think that's that we're going to make. There's going to be some sort of tipping point where we get to some point where it actually tips over. I think the standard models would tell you that the lags on monetary policy are 6 to 18 months, basically, in terms of the full impact flowing through the economy.
6 to 18
But it's not as though it arrives and all of a sudden you get to a day and it's that day.
That's the point I was wanting you to bring out.
That's not really where you're at. Yeah. But you're right that one of the things that delayed the impact in principle of the tightening the RBA started to deliver as of May of 22 was that we'd had all these, we'd had a lot of mortgage holders move into these 2 and 3 year fixed rate products. And so that meant that they had a bit of a delay in terms of the effect it was coming. Now, one of the things to keep in mind is that they did know it was coming though. So once the RBA started lifting rates and once the variable rates started going up, the fixed rate mortgage holders would have anticipated and they should have known.
Allowed for it.
Yeah, exactly. And then started to adjust their behaviour ahead of time. Yeah. Now, that's not to say that everyone did that, but some people would have done that. Yeah. I mean, the other thing that's happened is we have gone through, we've had about 2/3 of the people who were on these 2 and 3 year fixed rate mortgages that were mostly sub 2% roll off onto their higher rates already. And that seems to have happened without it being a large, sharp, we talked about the fixed rate mortgage cliff. That was the big way it was described. And I think that it's happened more smoothly than that kind of gives the sense. It's more like a stumble than a cliff in a way. Yeah. But there's a lot of other factors at work. I mean, one of them has been, as I say, they kind of were able to see it coming. The other thing that we can observe is the labour market has been quite strong, so people have still kept their jobs. The other thing to observe, of course, is that the housing market's been rising. House prices have been rising. So again, if people get to a point where they really are struggling, or it's just they're at the limits where they don't want to be, because it could be a preference, not necessarily to not be at those limits as well, then you can actually scale down. And as long as you can scale down, that gives a pathway at least for working through the challenge.
So the reason I asked that question is that we get a lot of potential clients that want to sign up with us to buy a property, but they go, I'm just going to wait for the perfect timing. And it's as if they're trying to look at all these economic factors of negativity in the media and interest rates and go, you know what, Rich, I think there's going to be a crash, or I think there's going to be a recession, or I think such and such is going to happen, so I'm going to wait till June next year. And I say to those people, well, look, you may be right, but you could well be wrong. And in that fact, the market might actually keep accelerating. And all of those people, go back to COVID times. I remember so many people thought, God, the market's going to crash. And in fact, the market just took off and it actually put property further away from people. So I say to people, don't just try to pick the perfect timing. Buy when you're ready to buy. Buy when you can afford to buy a mortgage and buy a quality property and hold it for the longer term. So just thinking about the longer term, Paul, what's your forecast for the property market? Do you have any view of the major capital cities over the next 12 to 24 months on where the market's going to proceed?
Yeah, sure. I think we've seen exceptionally strong house price growth this year on the back of this very large influx of people, this very big surge in population growth. And I think as we look forward, we look into next year, into 24 and into 25, that we're going to see some slowdown in house price growth. And for two key reasons. One, because population growth will slow down, and two, because well, the tightening of monetary policy has lagged effects, so it's still got more flow through to have, and when it flows through more, we'll see a bit more supply added to the market, and that combination, I think, will see things slow down. Plus, I mean, the economy we expect will slow down a bit further, or at least remain quite sluggish running into 2024, and if it doesn't, well, then inflation doesn't come down fast enough, so the RBA needs to make that happen. So I think we can, one thing to be reasonably confident of is actually growth in the economy is going to be reasonably sluggish next year. And if that continues, normally that puts even further upward pressure on the unemployment rate. It pushes, the labour market to soften too. All of that combination of things, I think, would tell you that house price growth should slow down. The question, I guess one of the questions is, will they actually fall outright? And that's a much trickier question to answer, but I think my first pass would be, that seems hard to think that you'd make that your central case, given how tight the housing market is, given the shortage of supply we've got relative to demand, given the very, very low rental vacancy rates at the moment, and given it doesn't seem likely that the RBA's got a lot more. I mean, it's possible the RBA comes into the early part of next year and has to lift interest rates a bit further. We can't rule it out, but I think it is actually unlikely at this point. I think if you sit back and look at what's going on globally, it looks as though the Federal Reserve, the US central bank, is done, and that their next move is more likely to be down, probably not until the second half of next year in our house view. In Europe, similar, we think the ECB is done. We think their next move is down, but we don't think that's happening till the fourth quarter of next year. And even the Bank of England, we don't think, which has got a higher inflation problem, doesn't actually lift rates again. So if none of those guys in the global scene are lifting interest rates again, it's probably less likely the RBA is going to lift rates again. So we don't get another rate rise from the RBA. If they're on hold, and I get the other forces that I've just described, it's sort of hard to think that house prices are going to fall from here. Yep. But it's very easy to think that they're going to slow down from the very rapid pace we've seen over the last
It seems pretty obvious. I'd agree. Totally agree with that. And another question I've got for you around supply. Do you think Australia's got a structural supply problem? Because the government's announced an ambitious plan to build 220,000 homes a year over the next 5 years. Now, we only ever got to that maybe once in the last decade. Do you think that's realistic, and do you think we have a structural problem?
We have a problem that we don't have enough housing supply. That's why house prices are high relative to incomes, and that's been a persistent feature of the story in Australia for quite a long time. So I don't think this supply side problem is a sort of cyclical dynamic of it's just now, but it's going to fix itself easily. It's a much deeper structural challenge that we have, and it relates to, I mean, again, and this is not that uncommon, it's similar in other countries as well, but it relates to the fact that we've got a fairly regulated supply side. We need more coordination between various arms of policy to try and free up urban infill, and also greenfield release of land so that we can have more housing built. You've always got the typical problem of locals not wanting more urban infill in their own areas, the NIMBY argument, which is very vivid and very clear. And what you can one thing you can say statistically, which I think is interesting about Australia, is we've got very low urban density in our major cities. In fact, if you ranked major cities across the world, our urban density in the middle of our cities is one of the lowest across the world. So that's quite something. And we're sitting here right now in HSBC's building in the middle of Sydney. If you look out across the city, you can see this story. Yeah, exactly. Because the story is you can see a lot of trees, you can see a lot of green, you can see a lot of detached dwellings, and you don't, like if you stood on a similar sized building in the middle of Hong Kong or Japan or Tokyo or New York or go through the list, you would have all these buildings and all these high-rise buildings. We don't have that. So because we choose, in a way, to have lower urban density and supply is more constrained, then the prices are naturally expected to be higher. So I think the answer is that we have some reasons why supply is constrained. If we want to release supply, there's a lot of things that need to be done to go down that, a lot of it's regulatory. And then at the moment, the immediate sort of constraint is lack of available workers because we closed the border for 2 years and we've had a resurgence of population with the reopened border, but we're still at a point where actually there's a shortage of construction workers to be able to meet that demand. So all of those things are going to be the sorts of challenges that any policymaker is going to have to deal with in terms of trying to deliver more housing supply.
It's interesting, some state governments, I mean, the Minns government's just announced improving some missing middle, some extra medium density zonings, which is coming through. So I think they're trying to address that. And I think you're going to see a lot more people having granny flats in backyards and that sort of thing as a way to address it.
So the other way this is going to work is the price mechanism is going to work, right? So the price mechanism works in the sense that one of the things that happened through the pandemic that was most interesting, actually, from a statistical point of view, is we had a whole bunch of people move out into separate dwellings. We created an extra 120,000 households on those estimates. 350,000 people changed their behaviour, and we had a fall in average household size. And why did this happen? Well, the pandemic was part of the reason. People didn't want to, people who lived with lots of flatmates might have decided they didn't want to live with those flatmates when they had to do lockdown with them. But the other thing that happened is a lot more people shifted to work from home. And that's become a structural feature. I mean, a lot of it's still quite persistent. So people need that extra room, that extra space, until, of course, the rents go up enough that they force people to start changing their behaviour. They start saying, well, actually, I'm going to have to move back with mum and dad, or I'm going to have to move in with extra flatmates, or new arrivals might have to say, well, we got to live in more group housing. So one of the other adjustment mechanisms in this whole sort of mechanism is an adjustment in behaviour.
Exactly. I've got another question for you around, distressed sellers or forced sellers, just that are suffering mortgage stress. Do you expect in 2024 that we're going to see an increased number of more motivated sellers or distressed sellers because they can't keep up with their mortgage payments?
Well, so far we've seen very low housing loan arrears, and we've seen low housing defaults as well, mortgage defaults. That's been a feature. And I think that partly reflects that the jobs market has been quite strong. It partly reflects that house prices are high, and that allows a pathway, as we've talked about, in terms of people scaling down if they need to, if they get... and so that second feature is going to remain as part of the story running into 2024. I mean, we think house price growth slows a bit, but we don't think we're going to see big house price falls. And so that should continue to allow that mechanism to be available, which then, may very well mean you end up in a world where, we don't see a large rise, certainly in loan arrears.
Great. A couple more questions for you, just around the strength of the economy. How resilient and adaptable do you think the Australian economy is to external shocks? When there's potentially a conflict with China, Taiwan, we could see the Gaza war escalate, maybe bring Iran and oil issues. Are there any, I'm asking you to crystal ball the big ones here, but what do you think? How resilient are we?
I mean, the answer to that, I think, is that Australia's economy is actually very flexible and fairly resilient to international shocks. And what we've done over the range of the last few decades is become more flexible by having institutional arrangements that deliver that. And one of the fundamental ones is the currency. The Aussie dollar, the fact that it floats, and that's frustrating for some people. I mean, for businesses, I talk to businesses all day long. That's my job, is to talk to a lot of corporates. And it's very frustrating that the Aussie dollar is very difficult to forecast, and that it can go up and it can go down and so on. But as I always relay to them, I say, well, yes, but it's the fundamental shock absorber for the Australian economy. If a negative shock comes from abroad, commodity prices go down, for example, the Aussie dollar tends to go down. That provides support for us. It makes us more competitive. Likewise, if we get a big positive shock, commodity prices go up, or the world has we usually have a stronger Aussie dollar, and that sort of cushions us from that excessive, a positive force that might come through to Australia's economy as well, that might be inflationary. So the Aussie dollar is a really, really big part of that. But beyond that, we've also got other institutional arrangements that allow the Aussie dollar to move around a lot, and for businesses and for the economy and the financial system to continue to operate. We've got deep liquid hedging markets that allow that to happen. So that's a part of it. We've got a fairly flexible labour market. We've got a fairly flexible property market. Product market. It's, one of the things that I think we need to keep in mind is that those things are all true, but we need policymakers to keep up the pace of reform to make sure that we do retain as much flexibility as possible. So while it's, I can say on the one hand, yes, it is flexible and there's all these arrangements that help us, the more we do to make the tax system more flexible and more efficient, the more we do on competition policy, the more we do on building good infrastructure, the more we do in terms of the industrial relations environment, the more flexible the economy will be, and the better we'll handle any shocks that come along.
Yep, brilliant. Two more questions for you. Paul, what business or sectors of our economy do you think are the most vulnerable going forward over the next 12 months? Do you think there's any exposure there from any particular sectors or particular businesses?
I think the main one that at the moment that is exposed is businesses that are consumer facing. This to get inflation down, the RBA has tightened monetary policy quite a lot, and the primary driver of that is to slow down the consumer. And if you're slowing down the consumer, they're going to do less spending. And if you're in the retail business or you're in a business that's consumer facing, you might very well be one that needs to, be very, you're in the line of fire in a way. You have to be cautious in terms of the way you approach things, and you need to be aware that actually consumer demand may weaken further or may actually continue to remain weak. So that'd be the main area that I would be sort of concerned about where things are weaker. It's interesting that the construction industry is one where you might, on the face of it, say we've seen a large rise in business insolvencies in the construction space, but a lot of that sort of a reflection of what happened through the pandemic. Materials costs went up. A lot of them had fixed price contracts. Forced a lot of those businesses into, to struggle, and some of them to become insolvent. But then there's still so much demand for property, and there's still so much construction in the pipeline that actually it's almost a reformation of the industry rather than one where you go, that's leaving the industry really, really weak. But that's certainly an area where we've seen obviously some shakeout going on as well. Yeah,
brilliant. And last question for you: how should the average consumer and home buyer, I guess, get prepared to deal with potentially an extended period of higher interest rates?
Yeah, I think when you look at what's coming, we probably are going to be facing a period where interest rates are elevated for a while yet, and it's likely that the labour market is going to loosen up a bit as well. That the unemployment rate maybe starts to rise. So I guess the way you approach that is to hopefully have saved and put some aside. Another is to take sort of practically look at the way you're set up in terms of as I've said, if people do feel like their mortgage becomes a difficulty, there are pathways. I mean, one of the pathways at the moment is in an environment where house prices are rising and there's no negative equity, there's still an option to scale down, which often can be a smoother way to deal with the challenges that come along. So that's another option to consider as I guess a flexible approach. We saw this during when the global financial crisis came along. Actually, when that happened back in 2007, 2008, there were quite a lot of households that really had too much leverage, and the economy took an enormous shock, obviously in the form of that. And one of the things you can see in the statistics is people did scale down from larger houses that had more mortgage to smaller ones, and that was one of the pathways or one of the things that helped a smoother adjustment to the shock that was being faced.
So one more supplementary question for you, then you're off the hook. Are you predicting one more rate rise, two more rate rises, and when would you expect a rate cut?
Yeah, I've got the RBA. I think they're done. I think there's a risk, and I would want to be clear about this, that early next year when we get back in February that they might feel they have to do a bit more, but that's not my central case. My central case is we're going to stay at 435. Yeah. But on the other hand, I don't think they're going to cut the cash rate soon either. I think they'll be at that 435 level for a while.
Q3,
for
Q4?
What it's, well, no, I haven't got a cut penciled in until the early part of 2025.
Wow,
actually.
Okay.
So just, to give a sense, and I guess you might ask why. So, why would they be that long? Well, partly because, the economy is actually holding up reasonably well, and inflation's still sticky and a bit too high. Those are the obvious reasons. But then the other thing to keep in mind is, they've lifted interest rates by less than a lot of the other major central banks. They've lifted it by less than the Fed and less than the Bank of England and less than the ECB and less than the RBNZ. And those central banks, they, in our house view, might be, the Fed isn't cutting rates until the third quarter of next year, and the ECB is not going to the fourth quarter of next year. So when you think about it in that ordinal sense, they've done less, and should you expect them to be one of the first to be cutting? In that sort of sense, maybe not. Maybe they'll be later in the pack. And so that's kind of how I get to, they'll be later in the pack, and so we should think about rate cuts as a bit further down the track.
Paul Bloxham, it's been a pleasure chatting with you. Thank you so much for your insights today, and thanks for coming on the Property Buyer podcast.
No worries, happy to help.
Thanks very much, everybody, for listening. We look forward to seeing you on another edition of the Property Buyercast soon. Thank you. Thanks for being with us on another Property Buyer podcast. If you have a question you'd like to ask, please click on the SpeakPipe link and we'll answer this during the next episode. If you're looking to buy a residential or commercial property in the near future and would like to get the added advantage of having a buyer's advocate on your side, then please reach out to my team today and send us your inquiry, and we'd be delighted to help. Please visit our website at propertybuyer.com.au, where you can stay updated with all my latest market updates, weekly blogs and live suburb profiles to help you make better property decisions. We look forward to connecting with you again on the next Property Buyer podcast.